Hey there, this is Steve Larsen and welcome back to video number 3. You guys are doing great, sticking with the material and learning all these concepts. Now today we're going to be talking about something that made all the difference. It's when I learned how the ultra banks and the super rich really were designing their plans and what they were using in order to make it all work. Now, a few years back, I was working for a bank and I was invited to a private banking conference in New Orleans. And in these conferences, they put us in small rooms and they're usually C-level type individuals that are going through different problems, whether it's regulation or asset allocation or we're comparing ratios or all that sort of nerdy fun stuff, right? Fun for me. Anyway, so my favorite part of this is that we take our financials before we come to the meeting and we put them in the same format. So everyone has apples to apples, the same format. So that we could look at different things. And then we would divide things and create ratios. And as we're in these conferences, they put us in round tables and we talk about the different current events and things that are affecting our businesses, things that are working well, things that aren't working so well, the problems we're having, the good times we're having. And then my favorite part is we compare those ratios. I'd like to see how we size up against other banks. And I was at this round table and there's this fellow on my right, and his ratios were smoking all of my ratios. And the competitive side of me was like, what in the heck? How are you guys doing this? Like, are you selling drugs on the side? Like, what is making this work so much more efficient than what we're doing? Because we're in the same line of business, but yours is performing far better than mine. And so I was talking to him and I was teasing him a little bit and he laughed at me. So he said, you know what? Steve, why don't you come join me for, we're having a little dinner here down in the French Quarter. Why don't you bring your wife and I'll talk to you about it over dinner. So he showed me where to go. He said, okay, be here by 6:30. He gave me the address. I put it in my phone, went down there. And if you've been to the French Quarter, there's some like really amazing places. And then there's some shady places like right next to each other. You don't know where you're going to be. So we're walking down this address and it's late at night, so it's dark. We're going through this alleyway. We go up these stairs and I'm like, okay, I think I'm gonna get my wife and I killed because it just felt like totally unsafe. Well, anyway, the address ended up being correct. We opened the door, it opened up to this beautiful banquet hall. In this banquet hall, it was cozy. There was only enough room for about 50 people, and there's probably only 40 people in the room that were dressed in suits, gowns, things like that. That, you know, it was just kind of a private event. So I found this fellow that I met earlier at the round table, sat down, we started, chumming it up a little bit. And then I'm like, okay, so how are you doing this? Like, I gotta know how to do this. And over the next few hours, he told me what he was doing to increase his ratios. And I was like, I don't know how this works well, but after he was explaining it to me, I'm like, the light bulb just went on, like this makes sense. And so what he taught me really hit home, and we started to apply it into our financial position, and it worked. It was like, I wasn't surprised because I already knew what was working for his numbers. But what was frustrating was like, how do you take that concept and apply it to personal finance or to a small business or things like that? So that's what I kind of went on this tear to do. So let me give you some context about what this is, all right? So in banking, let me give you some background. In banking, there are tiers of capital, right? There's tier 1 capital, there's tier 2 capital, and as the tiers go up, so do the risk levels. In order for a bank to function as a bank, they have to make sure they follow regulation. One of the pieces of regulation that's created is created by the Basel Committee, which is from Basel, Switzerland, and everyone agrees to kind of play by these rules, right? And there's this thing called a leverage ratio. Inside this leverage ratio, it compares how much tier 1 capital you have to how much at-risk investments you have on your balance sheet. And if you have too much at-risk investments on your balance sheet, things that are earning you, money, and you don't have enough tier 1 capital, then it pinches off your lending rate. All right, so what you can actually lend in the banking system. Now, I want you to understand this. In banking, lending money is their inventory. Money is their inventory. If you were selling shoes, you'd have a warehouse full of shoes and you'd be selling those shoes as fast as you can, right? Well, in banking, you have money and you're trying to get money that's out at work for you to collect interest on loans, fees, et cetera, et cetera, et cetera. Okay? So they have to make sure that you don't have too much at risk and you have enough tier 1 capital. So the problem is that tier 1 capital doesn't typically pay very well. If you put it at another bank or a CD, you're getting just a nominal rate of interest, and so it's really not producing enough value. So if you have millions and millions of dollars in this tier 1 capital category, it's really not at work for you. You don't have little soldiers going out there to battle to go bring more interest and fees into your bank. So conversely, if you have too much in at risk, what is at risk, right? Okay, so at risk are stocks, bonds, precious metals, oil and gas, any of those type of commodities, loans, cryptocurrencies, anything like that. All of that stuff is at risk. And so banks don't mess around with any of this stuff. They make sure that they have a solid foundation so they can have a lending rate, but we want to figure out how we can increase the effectiveness of that tier 1 capital. So what my friend taught me is how to create that effectiveness in that tier 1 capital through what we call a tiered banking contract. Now, essentially what that is let's say we're a bank and we say, hey, I want to put $1 million with this other financial institution. And in so doing, they're going to give me a contract. I'm going to keep this $1 million as tier 1 capital in my tier 1 capital section, right? And then doing this contract, in the contract, that financial institution is going to promise me a guaranteed rate of return. So it still qualifies as tier 1 capital. We're going to have no loan provision. So you can't, no loss provisions. So you can't lose money in the market. So it's safe, right? It still passes the litmus test for the Basel Committee. We're going to make sure that in addition to the guaranteed return, we're going to also add dividends on there so we get a higher, more competitive return. And what's amazing is inside that contract, the way that it's written in the IRS, it allows you to grow tax deferred, and if you structure it right, you can also have a tax advantage return of funds. So, you can't say completely tax free, but if you structure it right, you can really have a very tax efficient model. Now, what does this have to do with anything regarding your personal finance? And what we figured out is we found out a way to take that same tiered banking contract and bring it to personal finance, to small business, to family-owned businesses, whatever situation you have. We apply this same strategy so that we can get higher rates of return, tax-deferred growth, tax advantage return, no loss provisions. But what's awesome in this situation is that you have liquidity, use, and control of all of these funds. And in the next video, we'll talk about how you can get your money working in 2 places at the same time legally, right? And I'll teach you a little bit what's called financial arbitrage. This is how the big banks really improve their position. They're making money everywhere they go. And so I'm going to take those principles and I'm going to teach them to you, and I hope to have you implement those in your life so that you can continue to be more productive, more financially free, more at financial peace, and not worry about scarcity. Break the chains of scarcity and fear when it comes to dealing with money and the future of money, because that's my mission and purpose in life. So I hope you're enjoying these, and we'll see you in video number 4.